Hello, and welcome to Explain the Charts, your channel for no-nonsense technical and fundamental analysis. Today is October 27th, 2025, and we are taking a deep dive into XAUUSD, or gold, which has seen some truly historic volatility over the last week. First, we'll cover the major news events driving the market, and then we'll jump straight into the charts to see what the price action is telling us. The dominant theme in the market right now is a surge in risk appetite, fueled by growing optimism around a potential US-China trade deal. This optimism is pulling capital away from safe haven assets like gold, putting significant downward pressure on its price. Adding another layer to this is the widely anticipated Federal Reserve interest rate decision coming up this Wednesday. The market is expecting a 25 basis point cut, which would be the second cut of 2025. Normally, lower interest rates are bullish for a non-yielding asset like gold, as it reduces the opportunity cost of holding it. However, the positive sentiment from the trade deal talks appears to be overwhelming this typically bullish factor for now, creating a complex dynamic for traders. Just last week, gold was trading at record highs, touching nearly $4,380 per ounce. This was followed by a dramatic sell-off, with one day marking the biggest single-day drop since 2020. This was a classic case of buy the rumor, sell the news, as profit-taking kicked in and risk-on sentiment took over. Multiple reports have identified the $4,000 level as a pivotal psychological and technical support zone. Price has been hovering and consolidating just above this critical mark after the recent plunge. Interestingly, ONDA's client sentiment data shows that a large majority, around 76% of retail traders, are net long. From a contrarian perspective, this heavy retail long positioning could suggest that prices might have further to fall before a true bottom is found. Now, let's switch over to the charts and see how this news is reflected in the price action. Looking at the daily chart, we can see the spectacular bull run that gold has been on for the better part of a year. The trend was clearly defined by a series of higher highs and higher lows, a textbook uptrend. That uptrend culminated right here, around October 20th and 21st, where we printed the all-time high of $4,381. What followed was a brutal reversal that completely changed the short-term market structure. Let's zoom in on this recent period to get a better look at this volatility. Here is the action from the last couple of weeks, and this massive red candle on October 21st is what everyone is talking about. We saw a price drop of over 6% in a single day, wiping out weeks of gains and decisively breaking the upward momentum. This is a clear visual representation of the market sentiment shifting rapidly due to the news we just discussed. Since that massive drop, the price has entered a consolidation phase. The last 4 trading days have seen price contained within a range, indicating indecision in the market as it tries to find its footing. The low of this range is around the $4,000 to $4,070 area, which is our immediate and most critical support zone. A daily close below the $4,000 level would be an extremely bearish signal and would likely open the door for a much deeper correction. Based on the chart structure and analyst reports, the next major support level below that sits near the $3,850 mark. On the upside, immediate resistance is the top of this consolidation range, roughly at the $4,160 level. If buyers can push the price above this area, it could signal a short-term recovery is underway. However, a much more significant resistance zone lies between $4,220 and $4,250. This area acted as support before the breakdown and will now likely serve as a strong ceiling for any bullish rallies. Now let's switch to a lower time frame to analyze the current intraday picture. On the 15-minute chart, we can see the price action following the big drop from October 22nd onwards. This chart clearly shows the choppy, sideways consolidation we mentioned on the daily time frame. We can see multiple tests of the lows around the $4,060 to $4,070 area, which has held up so far. Conversely, rally attempts have been consistently capped, first around $4,150 and more recently around the $4,110 to $4,130 zone. This pattern suggests that while sellers are taking a pause, buyers still lack the conviction to push prices significantly higher. The price action at the end of last week, on October 26th, shows a clear bearish drift. We saw price fall from the $4,100 area down to the $4,060s, closing the week on a weak note. This aligns perfectly with the ongoing pressure on gold from the strong risk-on sentiment in the broader markets. For day traders, this range between roughly $4,060 and $4,130 is the key battleground to watch. A breakout in either direction on this time frame could signal the next short-term move. Given the weakness at the end of the week, the immediate path of least resistance appears to be to the downside, to retest those consolidation lows. So, to recap everything, let's return to the daily chart and outline the key takeaways. The long-term bullish trend has been broken, and the short-term momentum is now bearish. The most critical price level to watch is the support zone around $4,000. If this level breaks, our next major target to the downside is around $3,850. On the upside, bulls need to reclaim the immediate resistance at $4,160 to signal a potential recovery. Even if they do, expect very strong resistance in the $4,220 to $4,250 area. Now for our unbiased outlook. We believe the bearish scenario has a higher probability, let's say a 65% chance, in the short term. The fundamental narrative of a US-China trade deal is a powerful headwind for gold, and the technical breakdown on the daily chart is severe. A daily close below $4,000 would reinforce this bearish view. The catalyst could be the Fed's statement on Wednesday, if it's perceived as less dovish than expected, or if we get concrete positive news on the trade deal, expect sellers to take control. The bullish scenario, which will give a 35% chance, relies entirely on the $4,000 support holding firm. This scenario would be reinforced if the trade deal unexpectedly collapses or if the Fed is surprisingly more dovish than anticipated, which would weaken the US dollar. A confirmed break above the $4,160 consolidation high would be the first sign that buyers are regaining control. The main event to watch this week is the Fed's interest rate decision on Wednesday, as this will almost certainly inject significant volatility into the market. Thank you for watching this analysis on XAUUSD here at Explain the Charts. Please remember, this content is for informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own thorough research before making any investment decisions. Be sure to like and subscribe for more in-depth market breakdowns.